I'm going to discuss with you regarding equity savings fund. There is a new category of funds. Today the markets are at all-time high. Nifty is close to 10,000 and Sensex is reaching 32,000, or almost it has reached 32,000. So in general, mutual fund investors are worried that the markets are at a peak, whether it will fall, if so, how much it will fall, how to protect my wealth, or further I have right now money, 10 lakhs, 20 lakhs, 5 lakhs, whatever the amount, I want to invest this money, where I can put at a lesser risk. These are all many of the questions, being faced by investors in today's world. Particularly if you see right now, the fixed deposit rates in banks have come down to a great extent. Now it's around anywhere between 6 and 7% per year. Gold is giving negative returns. Real estate, of course, we all know there is not much return over there. So the only avenue left for retail investors as well as high net worth individuals today is the stock market related investments. That's where mutual fund comes in. So within mutual funds, most of the retail investors are focusing predominantly 100% equity oriented schemes. So those funds can give very good returns. At the same time, they also carry that level of risk. Probably whether the market is at a peak level today or not, no one knows. Really, no one knows. All of us can guess. When the market falls, then only people will say, in so and so year, in so and so month, it was a peak. Or if the market continues to rise, they will say, it is a bull market, so the next target is so much, so and so. Now we are discussing, about a category of fund which can replace your long-term fixed deposits. Say many of us, many retail investors invest in fixed deposits for 3+ years, 3 years, 4 years, or 5 years. So these investors, they want a decent return at a reasonable risk generally. So this is where the equity savings funds as a category comes in. How does these equity savings funds work? So they invest, the money collected from investors is invested in stocks, arbitrage and debt instruments. Say for example, if they collect 100 rupees from you, they invest approximately, we are talking 1/3 in stock market, which is, shares of the companies, of blue chip companies or mid cap companies, whatever it is. Another 1/3 is invested in arbitrage opportunities. So again, these arbitrage opportunities can earn around 5, 6 or 7% per year. The third portion is invested in debt instruments like bonds, money market instruments, treasury bills, etc. So in effect, out of the 100 rupees taken from you, approximately 33 is invested in stock market. Another 33 is invested in bond market. Another 33 is invested in arbitrage opportunities. So your risk is to the 1/3 of the stock market investments. Even in a hypothetical situation, if the market falls down by 50%, just let us assume, your investments, will not fall to that extent. Probably it might fall to a worst case scenario of 10 or 15%, again, which can be recouped in a year or two. So when you invest for 3 years in any given situation, 3+ years, your principal will be intact, but at the same time, you can expect an average a return of 9% per annum. Anywhere it can give anywhere between 8 to 10% or even higher. Some of the funds are giving higher returns, but a reasonable expectation would be 9% tax-free return over a period of time. The suggested holding period for these funds is 3+ years. So you consider that you are entering into a 3-year FD or 4-year or 5-year FD. So the risk levels are low. Similarly, the returns will be lower than a 100% equity fund or a balanced fund for that matter. So who can invest in these funds? To whom it is suitable? Generally, risk-averse investors, they don't want to take much higher risk, but at the same time, they want to earn FD plus returns. senior citizens who are looking for alternatives to their FDs, and people who are interested in protecting their capital more than wealth creation. So in a way, if you keep for 3 years, these funds will protect your capital. So these are all the categories of customers who can buy these products. Also, at this point of time, many customers are thinking whether I should switch some of my equity funds to a lower risk level or debt fund. Since debt funds are taxable, it is better to move into this category of funds, equity savings funds, to a certain extent, if at all you want. Otherwise, if your goals are much longer or if your time horizon is much longer, you need not switch from equity to this type of funds. If your goal is very short in the next 5 years, in the next 3 years, or if you are afraid of falling markets, those kind of investors definitely can enter into these schemes. You can invest bulk as well as through SIP also. Many people are going to post office and other banks for 5-year RDs or 3-year RDs, 4-year RDs. Those people can also consider these type of funds. The biggest advantage is tax structure. The investment in these funds are tax free if you hold on to them for more than a year, at least for a year. Similarly, the dividend received from these funds are also tax free. Nowadays, most of the fund houses are giving between 4 to 8% per annum dividend in these funds, depending on the fund house they are giving. Plus, you can expect some little bit of capital appreciation as well. So, if you want dividend, it is also tax free. If you hold on to the funds for more than a year, then it becomes tax free. So, it's a win-win situation: lower risk, reasonable return, tax-free nature. Probably next time you are thinking about low risk investment options, you can consider these kind of funds. Thank you. Have a good day.